Today we're going to talk about the topic why markets collapse when liquidity disappears. We'll be focusing on understanding what exactly liquidity is, why is it so important, how is it keeping modern economies alive, and especially what happens when it vanishes. Right? So, we hear about liquidity, especially when there is a financial crisis. We hear about it when there are press conferences that are happening, when the trading rooms are packed with panic, right? What do we hear? We hear that markets are losing liquidity. The biggest stakeholder, central bank, comes in. It injects liquidity in the economy. How does it do that? We'll understand it, right? So by understanding all this, we're able to understand what actually happened in the 2008 crisis, what happened in the COVID crash, how bank failures happen, why and how market panics, right? So first question was what liquidity is, right? As many people know, many people simply say being liquid is having ample of cash in hand. And yes, cash is highly liquid. Why? Because it can be immediately used anywhere for anything. See, cash is a currency, right? A currency has a value for both the buyer and the seller. So, any transaction can happen with cash as a medium of exchange, right? It is easy to use, it is fast, it is tangible. But real estate is also tangible, it exists. But the problem with real estate is that it's not a medium of exchange. Why? Because if, let's say, you are having a business transaction in which you say that, okay, take my real estate instead of money for me. But the problem is, real estate, either it is being transferred or converted into cash, takes time, right? You have to list your real estate, you negotiate and then close. Minimum to minimum it take 30 days for actual transfer to happen. That's the minimum. That's why it's not illiquid. It's not the best medium of exchange because it takes time. Cash doesn't take time. Cash can be immediately transferred and would have the same value, right? Now another thing, stocks. Stocks are liquid only and only when there are thousands of active buyers and sellers actually available, right? It can be liquid in a particular time when market operates. You can't sell a stock when the market is closed, right? So there needs to be active buyers and sellers, right? But talking about these three, this is only a surface level understanding. The definition of liquidity operates at a far larger scale than the which is the entire financial system. So coming back to the actual definition, we understand the mechanics, the medium of exchange, the transfer, everything. But liquidity as a whole is something this. Liquidity is a smooth and continuous flow of money. It is a continuous flow of money. What does this mean and why is it so important? See, money exists in economy, maybe in banks, maybe at home, maybe invested in businesses. It exists, it does exist. But the problem is, what if the consumers who are actually spending, who actually have the money, are keeping all the money at home? It is not being exchanged, they are not buying anything, money is not traveling to the businesses, it is doing nothing. It simply exists. There is no continuous flow. That continuous flow is basically liquidity. We'll use an analogy to understand the example more efficiently. We are taking oxygen for example. See, oxygen exists in air. We need oxygen, right? But the sole property of oxygen being in air doesn't keep us alive. It's the flow of oxygen into our lungs, maintaining our bodily functions, is what keeping us alive. So unless and until oxygen doesn't flow, we are not alive. So liquidity is basically the financial oxygen. Your body doesn't just need oxygen to exist, it needs it to flow constantly. And even for a second, let's say the oxygen stops flowing in the air, your body or the financial system in terms of liquidity, cash, it collapses. Right? Now, on to the next part. We'll be able to talk about how being profitable is not equal to it being safe. Again, this is how we'll understand about liquidity. Why having money owed, right, is not equal to being profitable. Let's say, for example, this is the income statement, a very small income statement. Let's say revenue. You are having a revenue of 100 rupees. Your expenses are, let's say, 90. What is your profit? 10 rupees. But the problem with this revenue is, let's say your 95 rupees are stuck. Where are they stuck? In accounts. They are stuck in account receivables. You don't actually have the money in your hand yet. 95 rupees are not in your hand. They are stuck in accounts receivables. How do you expect to pay this 90 rupees for your expenses this year or maybe the next year? You don't have the money. You are saying you recorded a revenue of 100 rupees, but what you actually have in revenue in sales is actual 5 rupees in cash. How do you expect to take care of these expenses this year or maybe the next year? You have a profit of 10 rupees, but actual cash in hand is 5 or maybe not. So being profitable is not being safe. You're not able to fulfill your uh, expenses, right? Your commitments in order to fulfill your expenses. A company can be profitable on paper and still collapse. That's how it collapses. Too much or AR, right? Business don't survive on profits alone. They survive on cash flow. There should be cash flowing in the system so that at least the expenses are taken care of. This particular statement we'll understand in the next uh, slide more easily. Now, modern finance is not a static sense. It needs money to constantly move in order to fulfill obligation, debt, confidence, and liquidity. Right? Now we'll understand the visual mechanisms of liquidity. So what basically happens? We earlier read that central bank are able to inject liquidity in the system. We have central bank here, but how does it do that? It forces the commercial bank to act in a certain way that helps injecting liquidity. How can commercial bank inject liquidity? Through loans. Who will take those loans? The business. What would business do with those loans? First, invest. Second, produce goods. Now, this production of goods needs two things: labor and capital. This labor will charge wages. So wages flow to consumers or maybe people who are working in the organization. They are actually the consumers because they would be actually buying the things in the industry. Let's say this business is a bread factory, right? The people working on wages in this bread factory would actually be eating that bread also, right? This capital we are getting from commercial banks, right? But this system is working. What if there arise a problem? What that problem could be? The problem in this situation would be lack of confidence. Who will have that problem? Commercial banks. They don't trust the people whom they are paying the loans. That is the business. So the money stop flowing to the business. They can't do investment. They can't pay wages. They eventually can't produce goods because labor is not there. They're not able to pay the wages. They don't have capital to actually operate. Money doesn't flow to consumers. Consumers doesn't pay the business to actually work. They need profit, they need revenue, they need sales to actually produce, right? Who, from whom they are producing the goods? Consumers are the ultimate shareholders, stakeholders in this situation. So this is where the problem arises. So if banks stop lending, payroll fails, production slows, and fear spreads exponentially through the system. See, the system is not able to work. Business are not producing, consumers are not buying. The system fails, right? So that's the problem. Now, moving further, where it gets brutal, the lack of liquidity, where does it get brutal? See, for that, we have to understand the bid ask spread, right? Now, what is bid ask spread? You can see this in a lot of places, but you don't know what it actually means. See, bid here is basically you are a buyer. You are saying for a particular stock, I am willing to pay $99.95. But the seller who holds the share is asking $100.05 for that particular stock, right? But this gap, this 0.10 cent gap is manageable. But when panic hits, see, what is panic? Panic basically means sellers are higher than buyers. You want to sell, but there are no buyers. This is where panic starts. The volume, the sheer volume of seller increases in terms of buyers. There are too many sellers, but no buyer. The buyer is saying I can only pay $80 for the stock that you are giving, but the sellers have to book their profit, make sure they're safe, make sure their loss is minimum. They are asking 105 for a stock. See, this 10 cents, they are manageable. There is room for negotiation, but not here. The spread. What is spread? Spread is nothing but ask minus bid. This is called the bid ask spread. This spread is $25 in response to the normal market where it's only 10 cents. That's exponential. This is what liquidity is. In a normal market, there is liquidity. Negotiations can happen, transaction can actually take place, but not in a panic market. So liquidity disappears exactly when the market needs it the most. Not during calm periods, not during ordinary days, but it vanishes at the precise moment of maximum fear when everybody is trying to sell at once and no one is willing to buy. Either if they are willing to buy, they are willing to buy at a price that is ridiculous, $25 less than what is being asked, right? So, understanding the entire situation with a numerical example, let's get to this scenario at first. Now, we're talking about a company who is holding 10 crores in property. Property could be any building or a factory which is helping them survive. They are doing business at that particular property. They are using equipment for that function of the business, that asset for a business. They're actually doing business there, right? Liabilities. You are holding 10 crores in assets in terms of property and equipment, but you owe 8 crores within 30 days. Another problem is cash available is only 20%. Only 20% cash is available on hand. That is 1%, sorry, 2% maybe, of actual assets owned. See, the problem with assets is, you can see here, you can sell those assets for 10 crores, give the 8 crore debt, you'll have 2 crores left in your wallet and still have 20 lakhs as well. So 2 crore, 20 lakhs is the figure that you see. But the problem is, if they sell this property and equipment today to give and fulfill the liability of 8 crores that they own, how and with what would they be continuing their business tomorrow? They don't have anything to work with at the first place. Assets are valuable, but they're not liquid. Why are they not liquid? This scenario is a panic scenario. Markets are panicking. If you are this, see, this is the book value. This 10 crore which you are seeing is based on the historical cost and nothing else. This is the book value. This is not the liquidation value. What is liquidation value and how is it difficult from book value? Is that book value is based on the historical cost of the goods in the market. But the current situation, the current value that you will get if you are open in the market of selling these goods is the liquidation value. Let's say the market is messed up, it's in panic. You go and sell out your assets, you'll only get 7 crores for that. There might be a scenario you will get 7 crores of the asset worth 10 crores, you have 20 lakhs on paper, you're still not eligible to make your all the liabilities go away, right? That is the problem. During a crisis, asset prices falls, buyers vanishes, credit line freezes. We have ratios to understand what liquidity is, to measure liquidity of a company. The basic ratio, the current ratio, let's use this for a while. Current assets are worth 2 crores, current liabilities are worth 1 crore. You have a fantastic current ratio, the ideal current ratio 2. It means that the company has twice as many short term assets as short term obligations. You are healthy for now. But if this is the situation, how is it healthy? A ratio of 2 offers no protection at all. Liquidity crisis doesn't care about the paper value. It doesn't care about this 10 crore. See, what happened in 2008 financial crisis was that the money stopped moving. And this is very important. How did it stop moving? Basically, what happened? Banks had a large portfolio of mortgages. Avoid the word risky for now. Their portfolio consisted of complex securities that were sold globally. And suddenly, it created a bubble. And what is the bubble most capable of? It is capable of bursting and reducing the value of underlying assets. So the housing value basically declined. That is what made these mortgages. The mortgages were a big part of their bank's portfolio, and the underlying assets of those mortgages, basically the value of that underlying asset decreased, which ultimately led to exposing massive hidden losses in the bank portfolio. See, Bank A has risky assets, Bank B has risky assets. Why would there be an interbank lending? It froze. They don't trust giving money to Bank B. Bank A itself is struggling. Why would it lend money to Bank B, who is also struggling for the same matter, same risk, same systematic risk? So, banks are not trusting each other. The trust collapses. When trust collapses at any given point in the structure, in the movement, the system ceases to exist. The real reason wasn't the falling prices, but the collapse of the trust. The real crisis was the money stopped moving, confidence evaporated, counterparty trust, the invisible glue holding system together dissolved entirely. That was the problem. Now coming back to the statement that we heard earlier, central bank injects money in the economy, right? So why central banks inject money, and how does they do that in protecting the system? How do they do that? So basically what they do is they do rate cuts. They lower down their interest rates to make the borrowing cheaper. If the borrowing is cheaper, businesses are prone to withdraw loan, invest in their business as much as they can. See, business was based on the principle of NPV, IRR. They use these measures, right? Now, the cost of borrowing, the ultimate factor in the weighted average cost of capital, is actually lower. This means the profits are bound to rise. The borrowing is cheaper, encourages them to borrow money from the bank. Banks are also encouraged to give out more money, and it keeps flowing through the system. The second thing that the central bank uses is bond purchases, which is also called quantitative easing. What they do is central banks buy government and corporate bonds. If they buy corporate bonds, they're actually essentially giving money to corporates and the government, right? So the cash flow is actually injected in these systems. They expand their balance sheet and dramatically. See, the central bank is actually giving money to the corporates in form of bonds, of course with forward expectations, but they are getting surplus money. They can use that money to actually invest on themselves, right? Now, another method is the emergency lending. Facilities like the Fed's discount window provide short-term loans to the banks facing immediate liquidity shortfalls. The lender of the last resort. The central bank is the lender of the last resort, right? So modern central bank is largely crisis management for liquidity. The goal is always the same: keep the money moving. Now, everything, no matter good or bad, in excess, it always causes trouble. See, we talked about what too little liquidity does. It freezes the credit market. Business can't actually borrow. There are mass layoffs because business can't actually afford to pay people. There's an economic contraction. Panic selling crashes asset prices. What in the case of too much liquidity? See, what happens is when too much liquidity is in hands of people, speculation rises. Speculation rises. What increasing speculation does is increase the chances of bubbles forming. Why bubbles forming? Why speculation? Why increasing speculation increases the foundation of bubbles being made? Is because they have less risk, because borrowing is cheap. Their risk taking ability has increased, right? So assets price disconnect from the reality. People are taking much more risk on a particular thing than it is expected to give. This leads to the formation of speculative bubbles like meme stocks, crypto, housing. In case of when economy is booming, you hear your feed is filled up with meme stocks and people discussing crypto, housing, everything. The most investment advice that you are getting from Instagram and everything is at the peak when the economic functions are doing their work properly. People have money, people are ready to take risks because the borrowing is cheaper, they have money, they have stable cash flows, and everything is going good. But ultimately, borrowing is cheaper, but it's not free. You owe the bank the money that you borrowed as well as the interest it's gonna charge. I know that's less, but still, it's leverage. The leverage towers grows dangerously unstable. When the borrowing costs nothing, investors stop asking whether an asset is worth buying or not. They only ask whether it might go up. And that's what ultimately leads to the creation of a bubble. See, in terms of the crisis that we recently had, what basically happened is in 2008 to 2050, the crisis was helped through quantitative easing. So, with the help of central bank intervening in the crisis management situation, it was flooded with cheap money and the markets rally hard. In 2018, Fed's attempt rate hikes. Markets throw a tantrum, forcing reversal. Right? Because ultimately Feds have to reduce the inflation because lower interest rates ultimately leads to higher inflation. So in order to uh, decrease inflation, ultimate powerhouse, the power move that the central bank has is actually reducing the interest rates. So it does that. Again, the borrowing becomes too expensive. People are having leverage position in everything possible in bubbles. So ultimately, crashes like COVID. Again, the Fed intervenes within the days with unlimited quantitative easing. Again, in 2021, meme stocks, crypto mania, SPACs, peak speculative access on cheap liquidity. Today, because of this central bank's criteria of coming between negative situation has made markets economical fundamentals being dependent on central bank. That central bank, no matter what, how bad situation is, they'll always intervene and protect us. The phenomena is called Fed put. The investors believe that the central bank will always rescue market during major stress. This belief encourages more leverage, more speculation, and enormous asset inflation. Today, markets don't just depend on economic growth; they depend on the continuous liquidity support. So, rather than investing with a proper mind, now they are basically doing are dependent on central bank, that central bank is always there to protect them, right? Now again, as we talked about earlier, the modern dilemma is inflation versus liquidity, right? This is a major tension. As I said, when interest rates falls down, inflation increases, right? Now rate hikes, right? In order to control the inflation, we have to increase the interest rates, which leads to increase in borrowing cost, and it basically tightens the market. As soon as the market tightens, there is market volatility, and ultimately it leads to market stress. So markets that spent over a decade addicted to near zero interest rates and endless QE react violently when the liquidity is withdrawn. Growth stocks, crypto, speculative assets built on cheap money, cheap borrowing money. Valuations reprice sharply when the Fed tightens in 2022. Right? Now, liquidity drives valuation. This is the key insight is most investors miss. It's not just earning or GDP that drives asset price, it's the availability and cost of liquidity. The invisible tide that lifts or sinks all boats simultaneously. Right? So liquidity is obviously a financial oxygen. Most people think markets run on profit, on earning reports and GDP and interest rate, but underneath all of it, beneath every trade, every loan, every corporate expansion, modern finance runs on confidence that liquidity always exists. And the central bank is the core reason for that. Right? The problem, the property of liquidity is it's invisible. As it is invisible, it's also fragile. Confidence can crash immediately. right? It's not the foundation, it can evaporate overnight. Without it, businesses collapse, markets cease, and entire economies can unravel within weeks. Liquidity is not just money, it's an invisible force keeping modern markets alive. And once you understand liquidity, you begin to understand how the entire financial system truly works. Thank you so much.